Pierre has a simple question, but it's complex. I don't know. He says, have you heard about the wheel strategy and what is the best strike price to aim for? To tell you the truth, I have never heard about the wheel strategy. Never heard it mentioned, never heard it brought up in any webinars. Of course, I've been, here with PowerOptions since 2002, 2003. I have never come across that term. I'm really sorry. Let's just take a look here and see what we can find. Okay, so this basic view here, I'm just reading it. An option strategy, blah, blah, blah. The wheel is sometimes called a triple income strategy. It's a strategy where a trader sells cash secured puts to collect premiums on a stock they wouldn't mind owning. The options expire or close for a profit without being signed. Premiums a profit. The goal is to set up trades and avoid being assigned. Next step of the wheel is to sell covered calls on the stock. Oh, okay. So the covered call is highly preferred to sell a call at a higher strike. Okay. At some point, the call is exercised and called away. You can simply sell the stock. When you add up all the premiums from selling the calls and puts, plus is desired and common end up selling and put for a profit. This results in triple income. Okay, so I don't think this is anything special, Pierre, to tell you the truth. Yeah, okay, John, thank you. John S. for helping me out here. What you're talking about is a cash secured naked put position and just the 3 outcomes of selling a cash secured naked put. All this is a naked put play. It doesn't need a specific name such as the wheel strategy. One of the most common things that investors do when selling the naked put. And again, here we are at SNBR. We sold a 60 put on a stock that was trading at 67.35. We're out of the money, took in about $1.53. And again, if the stock stays above 60, that put expires. You keep the premium. And you can sell the 60 put for the next month or the next 2 weeks out or so on. Okay? So you've got the cash secured put and you're all set. And it expires. Now, what's the other outcome? It falls below it. You're assigned. You now own the stock. So you convert that to a covered call. You've now got 100 shares of SNBR at your cost basis around $58.50. You sell an out-of-the-money call against it, according to the literature I quickly read, 62.5 or 65. Collect another premium, and you're good to go. All right? So that's another outcome in that case. Okay? Then, if it's assigned, you can just take all the profit or sell another naked put. And if the stock stays below 62 or 65, in that case, your call expires worthless. You still own the stock. You just do a second covered call. That's it. Other questions that came in, I think. Let me see here. Where did it go? Oh, okay. So the other question that came in originally from Pierre is, wouldn't you sell the 65 put? In this case, with a stock at 67.35. Well, a comment came in related to using a 0.2 delta. And let's see here. Where was that other one? Part 2 of the wheel strategy, generally done using a 20 to 30 delta for both the short put and the covered call. That's what William adds to us. Okay, Pierre? So why didn't I choose the 65? Well, you had originally asked, what strike do you do? It appears that most investors who've heard of the wheel strategy, so forth, let me clear those settings out there, clear the drawings out, are saying to use a delta between 0.22 and 0.3. And that's why I selected from the search here for the sleep number. That's a delta of 0.22. William also adds that if you are assigned the stock, so when the stock falls below 60, I'm assigned there. To give it more upside room for the covered call, the delta is also between 0.2 and 0.3, which would mean the 65 at that point. For the sleep number position, wouldn't the 65 give you a better premium? Absolutely. But again, from what I just read, from what our friends here are helping us out with, Pierre, it seems like the common approach for using the wheel strategy is to use a delta of 0.2 to 0.3. That's why I was at the 60. This one's at about 0.4, and the 70 is about 0.57 for the December expiration, which I chose. So we were simply looking at the 0.22 in the range that's commonly used in this case. And that's why. And then if I was put the stock, let's say the stock was at 70 and we had sold, it doesn't have a 67.50, of course. But let's say I was put the stock and the stock's trading at 67.35. Maybe I was put to it at 70 in that case. So then I'd look to sell the call with a delta going out now that I own the stock. What everyone's saying here is between about 0.2 to 0.3. So I'd be at the 75 strike to give more upside room and still get a little bit of premium. from what I just read in that quick 3 minutes, and from what William helped me out with on this case with the numbers, as well as something Octavio mentioned, but I think that was for a different structure, a different approach there. In that case, that's what you're looking for. William says, a very common strategy performed by financial advisors when they want to generate income for clients in retirement, since the fixed income yields are so low. That makes sense, yeah. It's a great way of using options, of course. Fernando made the question in relation to this also about how you control the risk in the wheel strategy if the stock plunges. Okay, well, that's the downfall, isn't it, Fernando, of a static covered call and a static naked put position. You don't have protection to the downside. We don't expect the stock to go bankrupt, but we're still risking the full amount for the cash secured put here, which would be, if we were put the stock at 60, mind you, we keep that $1.50, $1.53. So we're looking at a risk of 58.47 if the stock went to zero. If this was a covered call, buying the stock at 67.35 and selling the 60 call for, let's say $8.90 or so, because it's that deep in the money, we wouldn't be doing that following this wheel approach. But if I did this covered call and it still fell down to 50 or 45, I'd still be at that same loss area. Okay, so how would you protect it? Well, you'd have to buy another lower strike put, which would take away from the income, of course, as well. Doing these shorter term ones, you might convert this to a bull put credit spread by buying a December 55 or December 50 put. Let's just see what that would look like to hedge some of the downside. The 55 is not bad. 50 is pretty wide, but let's take a look here. So it's a 10-point spread. So instead of doing the cash secured amount, you only have to put up the margin, but now you're taking in 130, still risking 870. Standard kind of bull put credit spread view, in my opinion. 22 delta, 84, 86% probability of it expiring above the position. But now we're only allocating $1,000 for the 10-point spread per one contract instead of full cash secured amount. Okay. And this brings up a great point that William says that we always bring up as well, is that there's no real protection on the downside, of course, unless you convert the naked put to a bull put, or you convert the covered call to a collar. Simple as that. Financial advisors tell you that you sold a put on a stock you wanted to own anyway. That's right. So long term, you're still wanting to get into it. And if it goes down, brings up a great point, Pierre, that we should always remember, is that the first leg of this position is selling a cash secured naked put with the plan that if it expires, then you keep selling the puts against it, okay, to keep generating premium. And if it falls and the stock's put to you, well, you wanted to own it anyway. The key here is don't start this strategy on something that just has an inflated premium and is in the news and is not something you would want to own long term. If you're going to approach this strategy and this concept of selling the naked puts and eventually hoping to get put the stock and then turning it to a covered call play with leaving it out of the money, following this rough approach. And rough as I mean, I'm just giving you ideas of what we saw and what William and others are offering to us as well as follow-up and feedback. You should only do this strategy just like you should only do a covered call on a stock you'd want to own. I shouldn't do a covered call just because the premium, on a $10 biotech stock where the out of the money 12 strike call is worth $3. That tells me that has a phase 2 or phase 3 approval for some drug coming up. The stock could go up to 20 if that phase 2 or phase 3 passes, or it could drop down to $2 per share. It's not worth it. It's not worth that premium. Sure, you knock your cost basis down to $9 with that highly inflated premium, but if it drops to $2 per share, you're still down 86, 87% of what you invested in that position, and that's probably not worth it as well. So that, I guess, is the wheel. And why I'm referring to it this way, that I've never heard of it personally, is just because I apologize here. In general, we've got a lot of webinars here on, here's one, managing naked put positions. It's from a few months ago. But this concept of, I've sold a cash secured naked put. As Fernando mentioned, well, how do I address the downside? What do I do? Well, there's things that you can do. There's trigger orders that you might want to use if you don't want to be put the stock long term. Okay. In that case. And then from there, there's ways to manage it if it does fall down against you. You know, managing a cash secured put that is moving against you. What might I look to roll to? But in this case, you're looking to be put the stock because you wanted to own it long term, so you don't mind if it falls as well. But that is one of the options. The stock falls against you, you can roll the put down. You can close it if you have some profit, so you avoid assignment. If you decide now the stock's going in the wrong direction, it's not what you wanted, your sentiment has changed. Or allow the stock to be put to you, convert it into a covered call or a collar position that has some protection as well. Okay, so I'm going to get, that's where we're going to stop there on the wheel position, on the wheel strategy. Let's see here. Okay, so William adds some follow-up there as well. So this is an interesting one to me. So let me see here. Let me go back and make sure. Okay, William says the wheel strategy, sell to open short put to get the stock put to you. Once put to you, go to a covered call. This was his first one. I missed it. Preferable to do this on dividend stocks. And I don't know about that. Generally done on less volatile stocks, generally done with third Friday expirations, rinse and repeat each month. Okay, that's great, William. And they're trying to be safe, which is probably why William is saying to use the dividend paying stocks. Now I've got to analyze it though a little bit, William, don't I? See, if I sell a naked put on the first or second cycle, I'm sorry, let's go back here. And I don't think SNBR is a dividend stock. Do I have dividend on my? No, I don't. Okay, but let's just go into that profit and loss chart again. All right, there's our naked put. And here's the case. So I'm going out to December and I've got $1.53, fantastic. Now, the call premiums for December, the out of the money we might look at now, we saw the 75s at 115. Okay, so let's call it 130. It's a little bit less than that right now, than the 60. Okay, so it's a little bit less than the 60, but we're around the same ballpark. So William's saying that, you know, the financial advisors look for dividend paying stocks because they're safer. So when you do get put, you get the dividend. Honestly, in this situation, and it's an extreme situation, but I'd have to analyze this first. If I'm doing this approach, selling a cash secured put on a stock that I want to own that pays a dividend, and I'm selling out to December, and the first put with that 20 to 30 delta, we saw a midpoint of 153, and the 75 calls at a midpoint of, let's say, 135. Okay? So I'm getting 20 cents more here. If the ex-dividend date is coming up on December 4th, December 5th, somewhere in that range before December 18th expiration, and it's more than 25 cents for the dividend for the quarter, I'm buying the stock and selling the call. That's going to be higher than the put. I'm going to miss the dividend. I'm going to compare the two prices. Okay, so I wouldn't start it as a naked put if I'm coming up to an ex-dividend date naturally. I would just start it as the covered call. Ignore the naked put point. Just start it as the covered call. You get the dividends, and then you allow it to keep going with the stock going up. And then eventually, if you get assigned, as you were talking about in the wheel, you start over with naked puts then if you're not in that 30-day ex-dividend cycle. Okay. And yeah, he says dividend stocks are selected when a dividend is paid in the month that you get put the stock. Yeah, but you don't control that. The stock price controls that. So that's what I'm saying. If I was going to open a new position now, trying to follow this approach, I want to open it as a cash secured put, eventually have the stock put to me. But in that first cycle, the ex-dividend date is there. I'm going to compare the two prices. And if the price of the call premium plus the dividend I get is more than the 0.2 to 0.3 delta I would choose on the put, I'm just buying the stock right there, selling the call I would have sold if I had been put the stock, getting the income from the call, getting the income from the dividend, and just doing it from that part. I wouldn't, I wouldn't start with the naked put, but again, I'd have to look at the prices in that case and see that as well. So Octavio is kind of I'm not sure exactly what he's referring to here, but he says he sells a 2 weeks out 20 delta, similar to what William mentioned, this naked put. Does it work to sell a call for protection if on the last week the put gets close to at the money? Octavio, no. I wouldn't suggest that at all. So what Octavio is saying is that I'm here in this naked put position. Okay, let me just check something here. We're here in this. Let me do a different naked put. I'm going to use that. No. Yes, I'm going to use craft. I know. Lame stock. Okay, let's clear this out. And Kraft closed at 31.61. Let's go with the 32. Now let's go with next week. I apologize. Let's go with the 32 put, but we would have sold it when the stock was down at 31. So let's say we only got 35 cents for it in this case. Okay. So I'm in a naked put position. The stock's fallen to and below my put strike price. I'm right about at break even right now on this position. So I collected 35 cents for it. It's probably going to cost me 35, 40 cents to buy it back. I'm pretty close to break even at this point. What I personally will not do is sell a call against this now as a form of protection. If my sentiment has changed, I'm either buying to close the put and rolling. I'm sorry, if my sentiment's changed, I'm buying to close the put, taking the loss or the break even and moving on. If I still like the stock, I'll let it be assigned to me because I wouldn't have sold the naked put unless I wanted to own the stock and was comfortable owning the stock. This is not an approach here, even though you started off with a 0.2 delta. This is not an approach really to use for a stock you wouldn't want to own, I don't feel, at all. Now, then if I got the stock put to me, I could convert it to a covered call. What I'm not going to do, 7 days left to expiration, I've got a risk of, but I have a monetary requirement here of about 3,200. What I'm not going to do right now is say, oh, I'm going to hedge this 35-cent loss, and they're cheap, but I'm going to sell this 35 hedge, this loss, by selling another call. I'm going to hedge some of this loss by selling this premium here, selling a call to create a short strangle position. Now my margin requirement doubles. And yeah, each broker has their own way of calculating that. But this, to me, is not a good repair. Just generating premium on top of premium and creating a whole new position is not a good repair in this approach, I don't think. This is not something I would ever do. I would manage the position so I don't take 2 ways to lose, and I don't double my margin requirement just to try to repair a trade that's losing a little bit at break even. And again, I wouldn't sell this position, excuse me, even a 2-week out, 20 delta naked put, unless it's a stock I want to own, Octavio. I wouldn't do it just for the premium in that case. I forget the numbers off the top of my head. It's kind of close, Pierre. Pierre says, is a 30 delta equal to 1 standard deviation? I think a 35 is. Like 1 standard deviation would be a 65% probability. 2 standard deviations jumps up to 80, if I'm not mistaken, 78 or 80. And 3 standard deviations goes up into the 90s. And maybe I have that a little bit reversed, but I thought it was around 65, 66, 67% is 1 standard deviation, which would equate to a delta of around 0.32 to 0.3 and so forth. And that 0.2 to 0.3 delta, you're getting between the 1 and 2 standard deviation range in that case. Okay, and oh, William, so in the quick article I read, it didn't hint this as the third one. I could have clicked on 20 different links there when I did that quick Google search for the quote-unquote wheel strategy, which is just a common way, by the way, to mention. It's a common way that you would approach a naked put position. It expires, you keep selling, it gets assigned to you, you convert it to a covered call because you wanted the stock to own long term. The one article I clicked, which is probably wrong, William, but the one article I clicked there was just talking about how the 3 incomes were the initial one from the naked put, then if you keep selling the naked put, but then you get the premium from the covered call, you count up all the premiums, and then when you get assigned, that's the third. That's how they described it on that one. So it wasn't really a good write-up at all. I was just looking for something quick I could go through. But yeah, William's offering that the 3 income sources are the dividend, short put premium, covered call premium. And of course, the financial advisors don't compare the dividend versus the short put premium. They market the strategy as a flowchart type and make it sound so simple, but in reality, we know the market does not work that way. Absolutely. There's a lot of risks in that. And follow up, William, to that was actually before. He says most financial advisors do not know how to adjust option positions. So the wheel strategy is marketed as a simple income strategy that yields more income than the alternative of allocating 50% of a portfolio to fixed income, which makes a lot of sense. But again, when you break it down and you look at it as well, you run into that causality where, hey, even quality stocks drop 12, 15, 20% from time to time. Remember September, the 3 weeks of a very slow downturn. Hey, you get put the stock and then you sell a call. There is a risk in that too, by the way. Let's look at that very quickly. We talked about, I will go back to SNBR. I keep getting rid of that. All right, now this would be, I'm not going to say it's a lot of math, but this is going to be high math. Let me move this over here. By high math, I'm going to mean something that probably wouldn't happen, but we've seen a lot of things before. We're 30 days, 40 days out in time to December expiration with our first short put. Not a recommendation or suggestion. We just grabbed the first one out of the patented search tool for the naked put screen, and it did have that 0.2 to 0.3 delta that others were suggesting, William and others were suggesting, that would be used for the first naked put right. And Octavio said he was doing that as well with 0.2, but he's doing 2 weeks out. Now, the stock's at 67.35, okay? So if, lo and behold, we have a 20% decrease in the stock over this time period. We don't manage it, we just let it go, and it drops 20%. $13, $13.50, let's call it $14, okay? So it's now trading down to $53.35. All right, I know. Are we expecting Sleep Number to drop 20%? No. And that's one of the reasons why we chose the stock. I added that extra click there in the search to not see positions that had earnings between now and expiration. JD came up and I knew it did, so we wouldn't take that position. Well, it's a different approach. If I wanted to be in JD, I would, but again, another time. So the stock's down here at 53.50. Is that what I said? 54.50, 53.50. Let's just call it 54. Okay, so we're at $54 now. My cost basis on this position, we put the stock at 60. We kept the $1.50. Let's just call it a $1.50 premium. So my cost basis in the stock now is $58.50. Okay, and the stock's now trading at 54. Now the trick is, for January, or 2 weeks out, as Octavio said, the option with the 20 delta might be, if it's available, the 57.50. Okay, and this might only be offering, since the stock has fallen so much, and yeah, volatility's gone up, but it's a little bit out of the money, but this might only be offering, let's say, 80 cents worth of premium. Why is that dangerous now? Because if the stock recovers and comes back up to 60 and you get assigned, your cost basis was 58.50, you collected another 80 cents. So your cost base, I'm sorry, your cost base in this case would go to 57.30. Excuse me, it'd be at 57.30. So you'd make 20 cents a profit now if it recovered and you got assigned. What happened if it fell further? That's what it's going for. Let's say it fell to 51 and you got assigned here at 60 and had a cost basis of 58.50. And now the 20 or 30 delta is the 55. And you're only getting $1.10. Then you'd reduce your cost basis down to 56.40 with the covered call, but you're at the 55 strike, meaning if it rebounds and recovers, you actually get assigned for a loss. You got to manage it. You've got to roll it or do something else. And this is why, again, William adds that the financial advisors are using the dividend paying stocks, because you don't see that type of decline. Okay, you don't see usually a 20%. But he says good, safe, conservative dividend stocks, that's why they're used, but they can fall like a rock too. AT&T fell 26% in 4 weeks early this year. Kraft, the one that you've seen me and William with the married put, that's now a bulletproof position. I have no risk on it, still out to January. In that case, I got in, I think, at 28, wrote it up to, I don't know, I think it was 36, 30, 35 and a half, 34 and a half. Bulletproofed it then, and the stock fell back down to 26. And similar to AT&T, that was in a 3 or 4 week period where it dropped from 34 back down to about 27. That's about the same decline that you're looking at, and it's a strong dividend paying stock. And now, as we saw earlier, it's back up to 31. It bounces around a little bit. But yeah, no amount of premium or dividend protects one from that kind of decline. And that's why I use the married puts in those types of positions to protect against it. The idea there, Pierre, of course, is that using the dividend paying stock, you typically, hopefully won't see these, but we've seen a lot of new things in the past 3 years in the markets that go against it. But again, you see the issue here. Let's see it graphically real quick now that I just shouted out the numbers to you. Let's say that I'm put 100 shares of SNBR we knew my cost basis was going to be $58.50. But again, let's say the stock's trading at 51. And now that would be January, but let's say the 55 call is only trading at a premium of $1. Okay. Oh, sorry. Okay, let me think about this. Yeah, the 55 call is only trading at $1. I reduced my cost base, I'm sorry, to $57.50. I think I said $56.50, but I reduced my cost base to $57.50. If it now bounces back above 55, I'm getting assigned at a loss. Okay, so you'd have to pay attention to that too. And a great way, of course, to pay attention to that is using the PowerOptions portfolio tools when you're tracking your naked put positions. Just doesn't matter really. I'll just go, oh, why not? We'll go to covered calls from October 26th. So let's say I did that position. Oh, see, here's a lot of them. A couple of ones we did on October 19th during the webinar. That home group has dropped 33% on a covered call from when we got into it. Lovesac has dropped. These aren't real positions. These are ones we chose that were more volatile for this example. So we've got 2 stocks that are successful and 2 that have fallen the 20%. These aren't dividend paying stocks. These are sort of newer stocks. But in any case, let's say that I did do that. Let me think of a good example. I got a good example. I'm going to go AEM. This is one of my stocks too that's bounced around a little bit. And stock's at 74. It has been as high as 83 recently. So let's say that I had sold the 80 put for next week's expiration. And I had one contract, and we sold it probably at the time. Oh, let's just be nice and say $1. Let's go back a couple weeks. Anyway. There we go. Okay, so now the stock is down. It's going to cost me $5.95 to buy to close this stock. The stock's at 74.27. We took $1 premium to be put at 80, so my cost base is 79 on a stock trading at 75. Well, now that I'm tracking the position that's gone against me, we'll go to position actions and position analysis. See our original position is only 0.3%, so I probably would have gotten more premium. But in any case, you see our current loss, our expiration loss, we hold on to it. And then we see some rollout opportunities here. We could roll down the put and roll out the put. We'd have to roll further. Oh, and it did try, here's what it tried to do. So normally what you might see here in this case is it says your put is in the money. You may be forced to buy shares of stock if you decide not to close it. So you could just take assignment and convert it to a covered call. And what it did is try to find up to 75 day out covered calls. It would have a premium that would get this back to profit if it was assigned. The reason why you're not seeing any below here, any covered call rollouts, is because none of the ones that are available with the premiums would get us back to a positive % return if assigned, with the stock falling down to 74.27. It would still be a negative profit and loss chart. Now, you're right. If I sell that out of the money call and that expires, and then I sell it again, I'm lowering the cost basis, but it would put me in that negative. If I sold even the 75, it put me in that negative covered call position where if the stock recovered, I'd be assigned at a loss. And the system doesn't want to see that, so it's not showing those opportunities. But yes, if I sold the 75 or the 80 for a cheaper premium, which still wouldn't get me to profitability apparently, then that call would still expire. I'd lower my cost basis a little bit, sell another 80 call, and hopefully get back eventually to gain. Okay, so that's another risk with this as well that we just kind of covered, is that your downside isn't covered, as Fernando mentions. And you could take on a high risk. As William pointed out, the reason that some suggest this strategy is because, oh yeah, well, number one, cash secured naked puts and covered calls are really pushed by the brokerages. Level 1 trading allows you to do covered calls. I never understand why level 1 trading in options doesn't allow you to do married puts and collars and covered calls if you want the protection. It's a shame to me you have to apply to level 2 to get the put purchase price, to be able to purchase calls and puts so you can do a married put and actually have real protection better than a stop order in these cases. There's too many people make mistakes. Too many new people make mistakes going into covered calls for the highest premium. And that's a stock that has something coming up, which is why the premium is so inflated. And when the stock falls 15, 20, 30%, they're in big trouble. Didn't have the right protection in place. Stop order doesn't help them because that kind of decline is going to happen after hours. in that case. All right. Okay. So now I'm officially going to pause that conversation. It took us to 5:11, and thank you, William. Thank you, everyone, for your help with the wheel there. But Pierre, that's the answer for the wheel strategy. And again, you saw in the webinars, we have webinars on managing naked puts, the 3 outcomes. We just don't call it the wheel. We don't give it a specific name like that because it's just, well, a common strategy. It's a common way to manage the naked put since I've been trading with Ernie in 2003. Just didn't have a catchy name to it. That's all.